Greetings, traders. Jason here. It's just a couple minutes after 8 p.m. Central Time. On August 8th. Just checking my mic volume here. I think we're okay. Hope you're doing all right. If you can hear me, give me a little thumbs up. Let me know we're good to go. We should be good, I think. Cool. Definitely seeing some risk coming into the markets here with the yen pairs here. Fire and fury, Trump just said, if you haven't been watching the news much with regards to North Korea. How's it going, Yudi? Cat's Condo, nice to see you. So what we're going to do here is just have a overview about the intro and some sort of intro to moderate level chat about technical analysis and what it is. This little PowerPoint presentation could take anywhere from 10-15 minutes to maybe 25-30 minutes, and it'll be available on our YouTube page, recorded as well, if you want to take a look at it later. And we'll do some Q&A at the end. Just having a little lesson. I'm trying to put a little lesson together on Tuesdays here, and I think I have 2 more Tuesdays left of these lessons about psychology and trading and things. And then we'll be doing more of just the Asian session reviews as we've done previously, where we review the markets and talk about the trades. How's it going, Julman? Scalper? Nice to see you all. Welcome aboard, welcome aboard. So we'll get things rolling. So again, technical analysis, what is it? A lot of you, probably the majority of you watching this video, if you're in the chat room now, if you're on our page here at Forex Signals, just the fact that you're here tells me that you probably already know the basics of what technical analysis is. But I want to just review a few things with you real quickly, and we'll have some time for a little Q&A at the end. But again, I'm going to skip through these pretty quick. What are the 3 main chart types used across the Forex market? Number 1 is a bar chart. Number 2 is a line chart. Number 3 is a candlestick chart. So there's other types of charts, of course, as well. There's Renko charts, there's XO charts, there's people who would read the tape as it came out back in the old days. But these are the main ones that you see when you're watching Forex videos or taking a course from a different guru or trader out there that's trying to teach you. And I want to just give you an example of each one, plus many others. Bar charts, this is a screenshot now. I'm not live, so I can't pull this up. But bar charts, just in simplest fashion, they have this single line with a hash mark on the left and the right. The left hash mark on the bar shows the open of that price on that currency pair here, for example. And the left hash mark shows the close. So it's very simple, very clean. We don't have to worry about the different colors like we do with candlesticks, if it's red and green or open and closed candles. We don't have to worry about the colors around the edge of the candle that makes everyone's chart look different. It's just very simple. And to be honest, when you're pattern trading, which is one of the ways I like to trade, it's sometimes easier to see the patterns on a bar chart than it is on a candlestick chart, to be honest. So if you're not experienced with bar charts, I would at least take a look once in a while. Take a look at them, especially if you're maybe going through some more criteria before you click the button to get in on a trade. Just take another look at a bar chart. I'm still a candlestick guy like a lot of you are, but bar charts, you know, I've been around a long time, and some of the most successful traders do use them. Line chart, in my humble opinion, is probably the least accurate chart that's out there. Line charts, they show you the average between the open and close. I believe you can set the settings to show you the open or the close or the middle, and they just don't show you the extreme. So they look sort of pretty. I mean, you can see head and shoulders patterns and support levels here pretty easily, but they don't give you a really good representation of the volatility of the price action. And then, of course, we have our, at least my favorite, just looking at the chat here. How's it going, Stay? Julman, nice to see you all. Yeah, cool. Candlestick charts, my favorite. The way that I use my charts, I think most of you have seen them already. I have blue, some traders use green for up candle, and a red or downward for a descending candle. Let's see what I have here. Let me send a quick note here. Okay, good. Thanks for that. Thanks for taking the time. So candlestick charts, we have the wicks at the top and the bottom. You can see the patterns that will arise, like the tweezers, the railroading. You can see the engulfing a little bit easier. Either way, you get the reversals, the doji patterns, just easier to see in a candlestick chart. So let's move right on ahead. Support and resistance trading. It's just classic technical trading 101. And you can see here, what do I have here? Dollar yen. This is the 30-minute time frame. I don't usually use the 30, but it fit in nicely here. The 30-minute time frame, you can see the support and resistance lines where the blue arrows are. And the simplest way to trade is trade at the resistance and sell, and buy at the support, and have it go up to the top. The tricky part is, doing it in real time. Obviously, hindsight's 20/20. But if you look here at this chart, I'm going to give you a couple more examples of how this works. In a nutshell, let's see, I can't really move my cursor here, I don't think too well. Clicking on this slide. I'm so used to looking at the charts, guys. Let me just change this here. How's it going, Kitschy? Let me get rid of this. All right, so what we see here, I know you maybe can see my mouse just above my video here. What we see up here is the little wick that was the high. That becomes a resistance level. We broke through the resistance. We have the new high. And you can see what's interesting. This price action on the dollar yen pulls right back, almost right to the pip, to where the support level is now. So this resistance on the upward trend becomes a support level. And it happens again. We break through the resistance, comes back down, and you can see this last blue arrow. This area of support, which was resistance to the left, almost right to the pip. So one of the most successful ways to trade, especially on longer term time frames like the monthly, weekly, is to support and resistance trade and follow the trend. And if the trend's going up, you wait for a pullback. You can either use support resistance levels, you can use Fibonacci levels, and we'll talk about confluence of these signals here in a moment. Another way to technical trade is just simply trend line trading. This just happens to be the exact same chart I used before. When I was making this slide, I think I made this slide last year, I wasn't intending to use the same exact one, but I think it's a good example of how things can work together. And here's what I mean by that. You want to look for confluence of signals. That's technical trading 101. You see where these X's are flying in here? These X's happen to be confluence of a very simple signal, which is the trend line touches and the support and resistance levels. So if you look at each X, you can see that the trend line touches right near the support and resistance level. And those are areas of highly peaked market interest to see if we're going to break through or continue. And obviously hindsight's 20/20, but looking for these levels is key. If you're a new trader, sometimes this type of trading is probably the easiest and most simple way to go. I think I have a slide coming up a little bit here, but the important part to remember is the longer term the time frame, the more accurate that the pattern, the trend line, or the support and resistance levels might be. Because look at it, it becomes a self-fulfilling prophecy. You have banks, hedge funds, traders, trading robots, everything, right? They're all trading based on the high time frame levels. So when you see those levels come up, they're more important than they would be on a tick chart or a minute chart or a 5-minute chart. It doesn't mean you can't make money trading, say, a head and shoulders pattern on a 5-minute, but it's just more respected for the broad market on the longer term time frame. I'll give you a little bit more information on that. So far, just to refresh you, even though I've been going sort of quickly here, we touched on support and resistance trading, trend line trading, and now I'm going to show you the pattern trading. Let's see. Let me turn this down here. Let's see. All right. So head and shoulders, double bottom and double top. These are some of the more common ones. Triple top, triple bottom, wedges, triangles, flags and pennants, cup and handle, channels, and many more. So you'll see if you watch some of my trading videos what I like to trade and why. And these are some of my favorites. And I'm going to give you a few examples of these and how to trade them. Head and shoulders is my favorite. Double bottom, double top, triple top and bottom, wedges, triangles, flags, pennants, cup and handle, channels, and more. So I don't know how many of you know what this picture is down here. Let's see if my stream is coming through okay. How's it going, Amrit? Big Bear? Kitschy? Nice to see you all here watching. Appreciate that. This is a fractal. There's many different ways to break it down, but a fractal means that all the different price action, if you're talking about trading, now the fractal is in geometry as well and in nature, but it means that all the different, there's fractals inside. So all the little moves, as for example, Elliott wave counting, 1, 2, 3, 4, 5 waves, each one of those can be broken down into smaller waves and smaller waves and smaller waves. So a fractal is another way that you can trade on patterns. Let me give you some examples. So again, these are screenshots. These aren't live charts, so I can't really highlight with crosshairs here the way I usually do. But this is the dollar CAD 30-minute time frame. This is back on November 18th, and you can see the double top here. What happened right when that double top came up is price set this high. Boy, I wish I could point a little better here. Price set this high, was rejected, came back up right to that pip. I usually like to draw a colored box, and that colored box is sort of my hit zone or strike zone, if you will. And you can see that it got rejected and it continued down and pushed down all the way. Now, you won't see a move like this all the time, but the point is some people, especially if it's going in the direction of the trend, will like the double tops or double bottoms. So what I mean by that is this. Looking at this chart, because it can get sort of confusing when I can't move the charts around. Looking at this chart here, this is 30-minute. Let's imagine that the daily time frame and the weekly were in a downtrend, and that this big move up was simply just a retracement of the longer term trend to the downside. Then we get the double top, and we can see and expect that that area will continue to push down. So if you're trading in an uptrend, this is going counter trend, and it's a little more risky, although the risk is very well defined by just a few pips above this. Now you want to wait, and you want to address it depending on what you're looking at. If you want to be just a 5 pip or 10 pip or 20 pip stop above that level. But if you're trading with the trend longer term, trading a double top like this can be quite successful. Here's my favorite pattern to trade, head and shoulders. So we have the left shoulder, the head, the right shoulder, and the neckline. Most head and shoulders don't look exactly like this, and I'm going to give you an example of that here. Let's do it this way. Yeah, I think that will show up. Distance from the top of the head to the neckline equals the distance of the neckline to the target. So what happens is this H here, this height, can be projected for the target down low. I think you can see that all right, hopefully. So the neckline on the head and shoulders, the target would be the exact, sort of like an A to B equals B to C distance, either to the downside or the upside. Now, head and shoulders, like any other pattern, can be classic like this or inverse the other direction. I put this little image down here just to show you that what I was trying to describe earlier. The necklines don't always look exactly level. They can be angled like this. They can be even angled more. If it's really distorted, then it wouldn't be a head and shoulders pattern, but you can see even sometimes more than this. And I've done a few trades with you on my Asian and some of the US session reviews where head and shoulders patterns have worked really well. One of them was in the Euro Aussie, I think just a couple months ago. We traded a head and shoulders pattern that was inversed. We had the neckline, we had our target up high, we hit the target, price consolidated for a while, formed another head and shoulders, and then we sold it right back down again. It was just a beautiful inverse head and shoulders to standard head and shoulders. I think we were on the hour time frame on the Euro Aussie, and it was just a beautiful example of that. So the whole point of trading these patterns is you want the neckline on a head and shoulders, for example, to be as clean as it can be. You can either trade the breakout or the pullback and retest, as you can see up in this image up there. But it's nice when it is in confluence with other areas of the chart as well. So say this is right at a Fibonacci level, or say this is at a big figure, like if the euro pound comes down and be at 0.9 000. If you can have a Fibonacci level, a support and resistance level, a big figure on the price, maybe you check your news and you see that the news is pretty quiet, and you line up everything just right, it makes it better than a 50-50 odds for that trade, at least over time. Here's an example. This was, I believe, the dollar CAD. I put these arrows here because I have it off center a little bit. I just wanted to let you know I wasn't losing my mind here. But if you can see on the top here, we have a head and shoulders pattern. I drew the neckline here that's in that red line descending. And then we have a larger head and shoulders pattern with the neckline down below. So we have a head and shoulders pattern inside of a larger head and shoulders pattern. And if you shrink the time frame down a little, you'll notice that you see the larger one much easier than the smaller one. But what's really interesting about this is both of these patterns on this chart worked out perfectly. So the head and shoulders up top, we drew the neckline, and I can't click here and measure like I would on a live chart, but the top of the head to the neckline was almost exactly the same length from the neckline down to the target. And then on the larger head and shoulders, this neckline that was put in all the way up to the head, it produced a nice downward trend here, and the target was actually hit perfectly. So you don't see this quite too often, a head and shoulders inside of a head and shoulders pattern, especially on a moderately longer term chart like a 30-minute or hour, or looking at the 4-hour. You'll see it all the time on tick charts and minute charts and 5-minute charts, but it doesn't usually show up quite this cleanly. You can see this dashed line. I think this was a Fibonacci line here that really just respected those shoulders, were exactly well within a pip or so lined up. So head and shoulders and inverse head and shoulders, my absolutely favorite pattern to trade. I feel like they become more of a self-fulfilling prophecy than some of the other patterns as well, because they're easier to see for a lot of traders and the big banks and the hedge fund managers. It's just easier to see those types of things. Next we have flag and pennants. Fractals, you got it, Sivo 12. Head and shoulders forming a 1-minute chart on gold. I'll have to take a look at it. And I know if you're, a lot of you are more experienced and this might not be anything new, but for those of you who are new, it's sort of nice just to look at this and refresh. This was taken from chartpatterns.com. I just want to make sure and give them credit. So flags, you can see what happens here. It literally looks just like a flag. And here we have a flag in a downtrend. It's different than a pennant. Sometimes pennants are called wedges as well, but flags actually have to decrease a certain amount on the very bottom. And the way that we trade them is, at least the way I like to trade them, is A to B equals B to C. So I'm going to show you an example. I think I have one good example of how I trade them coming up right after this slide. But this is what we call a bull flag or a bullish flag in an uptrend. This is a bear flag or a bearish flag in a downtrend. And same with pennants. We have a bullish pennant and a bearish pennant, which can also be called wedges. Here's an example that I pulled up. This is the Australian dollar versus US dollar on the 1-hour time frame. Sorry if I'm looking up high here. I have my other screen up here, and I know I can't click on this one. Probably looks a little funny. Get my lights here right. Oh my goodness. So what you can see here is a rising pennant. Now this one is not a flag. A flag would have to come down deeper. But this rising pennant or wedge, if you can make out the orange arrows here, this orange arrow, the height of this in pips is exactly the same as this orange arrow. So the way I like to trade them is from the swing high down to the swing low, which would be right in this area here, and project that exact length from the top of the pennant to our target up high. Some people will take the bottom of the pennant to the top. I like to take the top all the way up to the top. So it depends on which person or which course you're studying from, but it is an A to B equals B to C. And again, I like to take it from the top of the pennant or flag up. Some will take it from the bottom up, but I think this is a little more accurate. And to be honest, it's a little more aggressive, and it gives you some more pips that way as well. So that's the way you would trade. You would wait for this to break, and you would buy the breakout or the retesting continuation. As you can see here in this 1 hour, we had a breakout where you could have had a pending order there, but there wasn't a retest and continuation. So remember on the head and shoulders pattern, I was telling you about how you could buy the breakdown of a head and shoulders or wait for the retest and continue. I like to take them right away. I like to do the break and get in that way, but it is a little bit more conservative and more safe to wait for a retest. It's just you're not going to have as many trades. You're going to miss a bunch of trades, but you'll also be wrong less often. So if this pennant, what I'm trying to say is if this pennant would have broke out, came back and retested, and this area of resistance at the top would have became support, but another chance to get long. So one of the strategies that I use when I step into trades or sort of pyramid in or add to is I always trade the second and third orders a lot smaller, usually 50%, sometimes 70% of the first one. And what you can do on something like this is buy the breakout, and if it comes back to retest, you can add again once it starts to take off. So there's a lot of different ways to trade this. But the point is we have a pattern here, a rising pennant or a rising wedge on the Aussie buck. So again, we had pattern trading, we had support and resistance trading, and we had technical trading. And I'm sorry, we had support and resistance trading and trend line trading. So technical analysis, if you just boil it down, those are some of the easiest things to watch for. Support and resistance, the actual trend lines that the candlesticks or whatever chart you're using are making, and then the patterns you look for within. Now, there's another very, very big one that has to be addressed in any kind of presentation on technical trading, and that is, of course, moving averages. So moving averages can be set to anything that you like. They can be anywhere from 1 up to, is sort of infinite, but I'll explain how they work if you're new to this. I use the simple moving average. You can see I have a 20 here and a 50 and a 200. Simple moving average is the average of the last 20 candlesticks. The 50 is the average of the price of the last 50, and the 200 is, of course, the average of the last 200. Now, simple moving average is just straight up the average. You can use a exponential moving average. You can use a weighted moving average, and there's also others. Most traders, I believe, at least the ones I talk to the most, use EMAs, exponential. I like to use the simple because I believe it's more true, and it takes everything into effect, even the swing highs and lows, the wicks, and the extreme moves. The weighted can be weighted on one area. The exponential has more to do with a standard deviation. It sort of flattens out the moving average. I just like it true, so I use the simple moving average for mine. And the 200, if you're not familiar with it, the 200 moving average is what a lot of the larger, longer term traders use to determine the trend. So if we were looking at this, what do we have here? Euro Aussie. This is a 15-minute chart from a while ago. It looks like it was from November, this last November. If we look at the green line, we're moving up, up, up. We're in an uptrend, and then it finally crossed over and broke. So you would say that we were in an uptrend based on the 200 moving average until it broke here and rolled over. The thing that's frustrating for me, and I'm hoping that most of you know this already, or if you're new, please take heed. Someone who's selling a system on how to trade moving averages is just old school, Forex marketing that's been around forever. And it frustrates me how many people are duped by this, but I guess if you don't know, you don't know. I mean, it's just sort of simple common sense. They'll say a moving average cross system. So here, if you can see my mouse where the 20 and 50 cross, they say sell there and take profits when they cross back over here. But what the totally new people don't realize is the price action is already way down when those moving average cross, because ta-da, they're lagging indicators. So moving averages are lagging, and you're going to get caught if you just trade with moving averages all the time and break even and losing trades. Because if you just trade this moving average cross of the 20 and 50 SMA to the downside, if you look at the candlestick, price is already down in this area. And when they cross here, prices in this area, this would be a break-even trade. But when I was new to trading, and you'd see all the fancy websites and people trying to sell you robots and courses for thousands of dollars, they'd say, ooh, from this cross to this cross, that's 40 pips. How easy is that? Look at this and look at that. And it just doesn't work that way. But it can give you a direction of the overall price action and the trend. So to summarize up moving averages, because we could talk for hours and hours and hours, probably hundreds of hours, on just techniques and strategies using moving averages. The way that I use them is to help me see where the chart is moving when I'm on a different time frame. So for example, let's say I'm looking at my cell phone and I'm looking at the dollar yen on the 1 hour, and I can only fit so many candles on my screen. I have the 200 SMA up there, and that tells me, okay, we're still in an uptrend, or we're in a downtrend on this time frame. It also helps when I zoom in. If I make my candlesticks really wide, it'll tell me, okay, price is coming down instead of going up, because you can only see a little snapshot of your chart depending on what time frame you're on and how zoomed in you are on it. So moving averages, in a nutshell, help to remind me what direction that the overall trend is moving on, whatever time frame I'm looking at. So that's the way I use them. I also use them when I trade divergence as filters. It's sort of hard to see here on this slide, but we have the MACD, which is the moving average, convergence, divergence, and we have the histogram there, and we have the stochastics here. I believe this one's set to 533, 833. I can't quite see for sure, but I use divergence of the MACD along with stochastics filter. Usually I have it set to 20 and 80, and I look for divergence patterns. So divergence trading is a lot more in depth. It's one way that I really like to trade some of my own accounts, more on the hourly or longer term charts. But it involves moving averages at the filter and stochastics and MACD all sort of coagulating together to give me the right entry on my trade. Now, just remember, these are lagging indicators. So you don't want to be caught with your pants down and get duped on some kind of system, because these are lagging. But it's just good to know. So I use the simple moving average, and the longer the moving average number, that's the flatter the line will be, and the less volatile it will be, and the more of an indicator of the overall trend. So the 200 SMA, in my opinion, is usually a good moving average to pick the trend overall in the long term. All right. So let's get on to a little bit more fun stuff. My favorite currency pairs to trade. I think I might have showed you this a few weeks ago, but I like to look at the Euro USD, the Euro Aussie, which is my absolute favorite pair to trade, the Aussie dollar, and the Euro pound. Euro pound this last 6 months to 9 months has made me more money than some of the other pairs. I also like the yens, dollar yen, pound yen, euro yen. I don't trade any other yen pairs at all. I mean, these 3 yen pairs are probably 99% of my yen trading. We're seeing the yen strengthen, I believe, if I look at my chart, because of uncertainty in the markets. Also, there's some JGB action going on, but there's a lot of bickering going on about North Korea and the sanctions and nuclear warheads and that kind of thing. So that's making the yen stronger. So these pairs are falling as I'm doing this video. I also trade gold and silver. XAU, USD, you can also trade it versus the euro or any other currency on the other side of this pair that your broker allows, but most traders trade it either against the dollar or the euro. The patterns will be totally different if you trade them, of course, against the dollar or euro. So the general recognized currency for gold is the USD, and for silver is also against the USD. And then the dollar CAD. I don't need to repeat this for those of you who've been watching me for a while, but the dollar CAD's my nemesis. I can make a lot of money and lose a lot of money on dollar CAD, and it just seems to be, out of all the currency pairs I've traded over probably 11 and a half years now, 11 and a half years, the dollar CAD is my most frustrating pair. I still trade it though, because when I get in the rhythm with the dollar CAD, I can do better than most other pairs. But then there's times where I just cannot get my rhythm on it. So I think we all, if you've been trading for a long time, you all have your favorites and you know your strengths and weaknesses. My strength is on the pairs I show you up above here. Most notably Euro Aussie, Euro Pound, some Aussie Buck, and then the yen crosses. I like dollar yen and euro yen the most, and silver. Gold, I do a moderate amount of trading, but mostly on silver, at least for swing trades that can last for days or a few weeks. I wanted to rehash this because I've gotten a few emails about how I trade and my analysis, so I just wanted to bring this up. I guess it is part of technical trading as well, but first of all, I think that you have to check news events. If you don't, even if you don't trade fundamentally, unless you're running an expert advisor or a trading robot or an algo or something like that, if you're trading manually on your own, I think that you have to look at the news events just to make sure you're not caught. Maybe it's FOMC tomorrow or non-farm payroll, or you're about to put a trade on the Euro Aussie, but there's an Aussie interest rate decision in the next 3 hours. I mean, you just want to look at the high impact news event. Hey, Jenny, what's going on? I haven't talked to you for a long time. Kitschy, have you ever used moving average trading using them as dynamic support resistance? I have back in the olden days. I mean, I think I started out like most people start out, where I did trade more with moving averages, and I just didn't do that well with it. But it's definitely something you can use. My advice would be, if you trade it, use it along with other things. Just use it as another filter that you can put in. So check news events, check the pair overall bias. So you want to know what's going on with this pair, right? Obviously, that's the whole point of trading. But for example, dollar yen right now, I'm not sure exactly what the price is at, and it won't be relevant anyway if you're watching this recording, but it's at 109.90. We know that the yens are strengthening. We also know that the dollar has been a little bit stronger lately. So if you're looking, for example, to sell one of the yen pairs, selling dollar yen might be just fine, but you might get more reward, more bang for your buck if you pick the euro yen or the pound yen right now, because they're starting to collapse a little faster. So you want to pick the overall bias. Where is the overall bias on the weekly, the monthly, the daily, and hopefully you can get your trade to be in the right direction. Top-down analysis, that's the next step I was just mentioning to you. Monthly, weekly, daily, 4-hour, etc. Check for correlating pairs. That's another thing I sort of already mentioned. If you know you want to be selling a yen cross, then find the one that's going to give you the most bang for your buck. For example, the euro has been weaker today. The Aussie has also been quite weak here in the last few hours. So selling the euro yen or the Aussie yen would fit these criteria so far. Number 5, look left for clues. Look, there's nothing worse. I mean, I've done it many times. I'm sure a bunch of you have done it if you're trading live. And that is, you get everything set up, you look at things, you're ready to go, you get your trade going, and then you find out you sold right at support that was on the daily or weekly, but you didn't zoom out long enough to look. So you want to look left for the clues. And when I say looking left for the clues, that includes patterns, that includes trend lines. Let me just get to the next one right away. That includes the key levels. It includes Fibonacci levels, which I do use a fair amount in my trading, especially if I'm looking to re-enter a trade or scale into a trade. So look left for the clues. I mean, it could be a big figure, maybe a 1.000 level. It could be a level that was very important on another key pair. What I mean by that is, say you're trying to sell the euro yen, but the euro dollar and the euro pound and the euro Aussie are all right on a very strong support level. That is going to affect that euro when those levels come up. And it's not that common, but sometimes they all correlate, and that could put some strain on the chance of your euro yen going down, unless you're just a straight breakout trader. But you can see what I'm trying to say. Look at other pairs, look left for the clues, zoom out, do top-down analysis, look at your news, check your structures, and I had, where is it here? On the bottom of this slide in the corner, I had some other steps in my analysis. You have the idea, you analyze, this is the part of the analysis. You decide on what you're going to do. You calculate your risk, whether you're risking 0.5%, 1%, whatever it is per trade, and you calculate your risk to reward, 1 to 1, 1.5 to 1, 2 to 1, 3 to 1, whatever it might be, and then finally place your trade. So these 6 points here are actually all included in the second step of the way that I take my trades. And I've said this many times before. If you've been around, you probably heard it a bunch of times, but I don't need to look at the monthly and weekly chart for the euro dollar every day or every hour, because it doesn't change. A monthly chart isn't going to change a lot hour to hour or day to day. So when you're plugged into the market, you don't have to always go and do the full top down before every trade. But if you haven't looked at it, you want to be aware of what's there. So let's see what the chat's saying here. China CPI, Aussie dollar finally broke down. Hey Jenny, 2 to C. I remember that. We used to say 2 to C or 2 to sky. Do you sell any of the Aussie pairs? Yes. Okay. So if you have any other things you'd like to add, if you have any other links you'd like to share with people, or any kind of files you want to share here about technical analysis, about preferences for charts, whether you use a bar chart, a line chart, a Heikin Ashi chart, a Renko chart, candlestick chart, whatever you like to use. If you have some good examples of trend lines or support and resistance trading, or even just letting us know what your favorite pattern is. Feel free to leave it in the chat here. Or you can put it in a comment if you watch this video on YouTube. It's just good to have discussion, you know? Good to have things to talk about with everybody. Trying to give you a little intro. I think some of you know this already, but just in case you don't, and it's not a big deal, but I think the last couple of weeks of August, Andrew won't be doing the streaming, so I put in a bunch more sessions. I'm going to be doing some of the US sessions, the Asian session reviews, and I think I have 13 more live streams this month to do. So I'll be ramping up my presence here at Forex Signals again the last couple of weeks of August, which should be fun. I always do better on my personal trading when I do more live streams because you get so plugged in. Not a stream like this, which is more like a lesson, but chart analysis. Let's see. Nice. Thanks for sharing that. VDUBUS. Truman, hey, have you ever used a COT report? Commitment of Traders report. I studied it for a while. And if some of you might be experts in this, I am not. So you can correct me if I'm wrong on here, if I say something that's incorrect. But the COT report is called the Commitment of Traders report. And what it's intended to do is show the direction and the nature of the big banks' preference on different currencies. So for example, on the Euro USD, the most commonly traded Forex pair that we have, if you look at a COT report, you can see the net longs or net short positions for the large banks. And then there's entire courses. I remember courses that were for sale for $3,000, $4,000, $5,000, teaching you how to trade the way the big banks do, follow the big money. Why do you want to trade like a retail trader? So look at the COT or Commitment of Traders report and trade the way the big banks trade. So it sounds really good and it does make a lot of sense. I'm not knocking it at all. I just found that for my style of trading, it was very difficult to find an edge using the COT reports, because when I found that all my other criteria lined up, for example, if I was trading divergence and I was also getting a head and shoulders and it was with the trend and it was at a resistance level going downwards, or I'm sorry, support level going downwards, that I would look at something like a COT report or even just the net traders on something like MyFX Book or Forex Factory, and it would be opposite, you know? So COT reports, again, in my opinion, I think they're good to learn about. I think it's good to know what's out there. I think it's just more for longer term. You know, if you're going to trade for days or weeks on end, which is what I usually don't do. So very good though. COT report. And if I put it in Google, like any of you can do, of course, I think you can get it all for free. Yeah, free COT data, COT base. I think there's paid and free ones. And it says here, the Commitment of Traders is a weekly report released by Commodity Futures Trading Commission. It outlines how different types of traders are positioned in the futures market. The two main types are commercials and money managers. So you get to see what the big boys and girls are doing. Here's one selling it for 10 bucks a month, and you know, so definitely interesting to look at. And if you're new to trading and you don't know about COT reports, I would look it up, because I think if you want to be successful in trading, you have to take all this information from Andrew and Tony and myself and Nick and all the guys and girls here at Forex Signals in the group, the forums, and take it all and distill it down into your own trade plan. And I think the more you know, the more that you can be comfortable in your trading. So if looking at COT report is for you, I'm all for it. My experience is that I did study it. I did learn it. I actually, I think I read a PDF course on it years ago, but it was pretty long, if I remember right. I think it was 20-some pages, just explaining, you know, the big picture. I may have even subscribed for a paid service for a couple of months, 6, 7, 8 years ago, something like that. Cool. What else? TK, Jaime. Jason, calculating risk is hard because of the difference of pip price. Any suggestions, or do you have a formula for this purpose? Absolutely. I use a trading pip calculator, and the one that I use, I'm going to put it up here for you. I'm sure there's a lot of them out there. but this is the one that I use. I used to trade with FX Pro years ago, and this is the pip calculator that I still use to this day. And you can find a lot of them. Just Google search trading pip calculator, and it'll let you know. For example, the Euro Pound has much more value per pip than something like the Euro Aussie or the Dollar Yen. And that will always be in a state of flux, albeit a small amount of flux based on the price of that currency pair. So the majors, like the Euro Dollar, it's always 10 bucks a lot. The Pound Dollar, 10 bucks a lot. Aussie Dollar, 10 bucks a lot. When you start getting into the crosses, it's really, really different. So use that pip calculator. That'll help you out. Irba says, yes, EAs can do the math. You got it. Big Bear, Jason says, what is your opinion about having a risk to reward ratio at least 1 to 2? Some people say it's irrelevant because you'll be stopped out twice as much as 1 to 1. I like having a risk to reward greater than 1 to 1 for every single trade. Now, again, I'm just streaming. This is my opinion. This isn't a solid rule. It doesn't have to be 1 to 2. It can be 1 to 1.5. It can be 1 to 1.25. It can be 1 to 3. Obviously, the greater your target is, the less chance there is for that target to hit if it's further away. I like to be always greater than 1 to 1 because that means I don't even have to be right half the time and I can still make profit. There's a whole strategy and mindset to this, as you probably know if you even asked the question, but I like always trading more than 1 to 1. I know Andrew does all the time, always greater than 1 to 1 reward to risk. This can be for scalping or for intraday or swing trade, longer term trades. Ideally, 2 to 1's nice, but 1.5 to 1 I think is a little more realistic. Every trade, every pair is going to be different. What I like to do, especially like posting trade ideas and things, is I like to always make sure I'm greater than 1 to 1, and then I try to set it to the next level. So example, I posted a trade on the Euro Pound, greater than 1 to 1, and I set my target just above the big figure of 0.9000. I think I set it at 9005. You could put it at 9010 if you wanted, but my opinion is to always be greater than 1 to 1. You have traders that will do the opposite and they can be successful, but that's just my opinion on it. You got it. That's right. Irba says when you have to, even though you know the pip value, you still have to calculate position size. That's right. And there are expert advisors and robots and things you can put right onto your chart that calculate for you. But I like to know, when I'm trading, especially when I'm scaling into a trade, I just like to know if I have 3 trades, say I have a 1.5 lot order, a 1 lot order, and a 0.4 order and scaled in, I like to know, okay, I got, say, 2.3 lots. I'd like to know, am I at 20 bucks a pip or am I at 30 bucks a pip? I think it's just one of the things I like to know. Technically, it shouldn't matter once you've calculated your risk and already put your trade on, but you still have to calculate the risk to reward. So risk to reward on the chart is irrelevant of the pip value, of course, because it's all in pips. You got it, Big Bear. How's it going, Kiwi Shane? Nice to see it. I use this one. There's a downloadable NT4 version that is really good. Cool. You brought up a really good point, too. There's a lot of people who are, maybe they're not, on a scale of 1 to 10. Let's say 10 is your full-time, you're trading, you're managing money, you're teaching, whatever you're doing, you're like really, really deep in the market. And 1 is like you just want to learn about Forex. You don't really know and understand what it all is. There's a lot of people that I've talked to over the years, because I've talked to hundreds, if not thousands of people about trading in the last decade or more, that can be at a level 2 or 3 or even a level 4, and they still don't understand that the pip value is different on pairs. And maybe it's because they trade just the Euro dollar or Aussie dollar or something, but it's really important to know that. So this one's from Earn Forex. Yeah, that's good. Some of the pip value calc, I know this is getting maybe a little deeper, but it's fun to talk about. I love Forex trading, of course. I wouldn't have been doing it after all these years. But some of the pip value calculators require you to put in the actual price of the cross first. So you have to put in the value of, say, the dollar yen right now, and then it tells you. But most of these on the web now, they pull right from live data, so you don't have to put that price in. Just one less step. Hey, Jenny. I don't think those questions you're asking are for me. I think that's for Earbus. Cool. Well, that was just a little primer on technical analysis. Fun to chat with you all. If you need anything, if you have any questions, feel free to send me an email, jason@forexsignals.com. I'd be happy to either help you out and hopefully solve your issue if you have one myself, or I can at least direct you and tell you where to go to get your question better answered to support, whether it's with a broker or it's with the website, wherever it might be. I'm really here to help you out. I love what I do. I wish I had more time to do it even more often. Hopefully that'll be changing here in the future, and I will see you all even more. Make it a great day, great night, wherever you are in the world. Happy trading, and thanks for watching. Take care.